Though with our talk of the tape, out of steam. That's how the market certainly acted today. The pullback perhaps pushed along by more Fed hawks talking about higher rates for longer, even as some suggest a soft landing looks more likely. For what all of that means to your money, let's welcome in Josh Brown. He is the CEO and co-founder of Ritholtz Wealth Management, a CNBC contributor. It's good to have you back right here with me at Post 9.
Loving it.
Have a nasty day.
Yeah.
Out of steam, out of gas, pushed over the edge by some Fed hawks. All the above. What do you think?
I think it's okay. Listen, I think it's okay. We've had a really big run. So far, we're just digesting that run. We were on the half yesterday talking about, look, we know the data is going to get worse from here. It's going to deteriorate. That's what you had today. Retail sales fell 1.1% in December. Negative 1% was expected. Doesn't sound like much, but that is the biggest monthly decline for all of 2022. So we finished the year in much worse shape than we were for much of the year, at least on that measure. Retail sales have now fallen 3 out of 4 months, Scott. That's notable. The Empire Manufacturing Survey was another one that got people's attention. This was the 5th worst contraction ever since they've been keeping this data. It was the weakest since March of 2009, taking out the COVID stuff. That really is a big asterisk. That's getting people's attention. That index is in contraction 5 out of the last 6 months. That print was twice as bad as what people expected. And so what I would say is, look at the 10-year, look at bond prices screaming, look at yields melting away. The market is now doing something very interesting. It's actually reacting badly to bad news. That tells you fear of the Fed is not the story this year. The story is, uh-oh, what have they done? Have they gone too far? Well, are they going to recognize it? That is the new paradigm we find ourselves in here in 2023.
It's fear of the Fed, just in a different way. It's of over-tightening.
Fear of what the Fed has already done. It's retroactive.
Not only that, but what they're still pledging to do. You hear Bullard today?
Yeah.
Bullard 5.25 to 5.5, go 50 next meeting. Now, he doesn't have a vote, but nonetheless, his words matter, right? This is like, we're going, and we're going to stay there, and we're going to go more than you think.
Because you know why? Because you can't undo everything that you've already done. You can't allow a 10% S&P rally to reignite manufacturing and retail sales and housing. Like, you really want to avoid having that outcome. And so what do? Well, you're not going to do 50 basis point rate hikes every month anymore. So the other tool you have is to just tamp down people's enthusiasm, make sure everyone knows you're going to stay vigilant, and keep the CFOs on track to continue firing people. I hate to say it that crassly. I hate to be the person that says it out loud. That is literally the thing that the Fed needs to continue in order for that 3.5% headline unemployment rate to decline. That is the only way they could declare victory. You cannot declare victory against inflation with the labor market as tight as it still is, despite the fact that we're hearing about big companies doing big layoffs. It just isn't enough yet, and so you're going to continue to hear the hawkishness.
What do you think the Fed thinks about this move we've had to start the year in the stock market? Bitcoin up 20% in a week, ARK stocks. It's kind of the trash is this, few weeks worth of treasure, so to speak. What do you make of that? What do you think they think of that?
Well, I think the Fed would not, other than Kashkari, would not publicly comment on it or offer any kind of an opinion. But I would tell you, it's not what they're looking for. It would not. Look, I don't understand this whole mentality. We talked about it on the show. Like, yields are backing off. Let's pivot back to buying garbage on the NASDAQ. Like, I don't subscribe to that being the right thing to do right now. I said yesterday, stick with what's working. Dividend aristocrats, high cash flow, high quality. Even if you don't outperform over any arbitrary period of time, you're not going to look like a fool that bought the top once again. I also don't like the VIX as a teenager. I think it's a mistake for us to get more bullish on a day like yesterday. You open up, you hit like 18 and change, 19. That is not where risk should be priced right now. So I think today just reverses a little bit of that. I'm happy to have been slightly ahead of the curve. The rest of this week might end up looking like today. I don't think it's the end of the world. What we're really doing is retracing a lot of the gains that we've gotten since Jan 1. It's okay.